The grand unveiling. All right, let's dive straight into the deep end of the pool. We're talking about US taxes. I know, it sounds about as thrilling as watching paint dry, but stick with me. We're talking about write-offs or deductions. A write-off is an expense you subtract from your income. Think of it like this. Your income is a big pizza. The government wants a slice, a tax slice. A write-off makes your pizza look smaller to the taxman. It doesn't mean the expense is free. You still spent the money, but it reduces your overall tax burden. If you're out there hustling, running your own business, whether it's a tech startup or selling artisanal dog biscuits, listen up. The US tax code understands a fundamental truth. To make money, you often have to spend money. The magic words you need to tattoo on your brain are ordinary and necessary. For a business expense to be deductible, the IRS says it must be both. Ordinary means the expense is common and accepted in your trade. Necessary means the expense is helpful and appropriate for your business. Keep it clean, keep it business-focused. Alright, let's keep digging into this treasure trove of business deductions. What else can you, the savvy entrepreneur, potentially write off? How about business travel? Yes, if you have to travel away from your primary place of business for work-related reasons, many of those expenses can be deducted. This includes the cost of flights, train tickets, taxis, and even your hotel or other accommodation. However, there's a catch. The trip must be for business. And what about meals while you're on that business trip, or when you're wining and dining a potential client? Generally, you can deduct 50% of the cost of business meals, provided they aren't lavish or extravagant under the circumstances. Also, you need to keep records: who you met with, the business purpose, the date, and the location. No documentation, no deduction. Next up, vehicle expenses. If you use your car, van, or even a unicycle, if that's your business, no judgment. For business purposes, you can deduct some of those costs. Finally, let's not forget professional fees. If you hire a lawyer to draft business contracts, or an accountant to help you navigate these very tax laws, or a consultant to improve your marketing strategy, their fees are generally deductible business expenses. Just make sure the services are directly related to your business. The home office deduction. For many freelancers, remote workers, and small business owners, this is the holy grail of write-offs. The dream of claiming a part of your rent or mortgage because you work from your spare bedroom. It sounds amazing, and it can be, but it's also one of the most misunderstood and, dare I say, abused deductions out there. The IRS knows this, so they tend to look at these claims with a bit more scrutiny. The absolute cornerstone of the home office deduction is the exclusive and regular use test. This is where many people trip up. Exclusive use means that a specific area of your home must be used for your trade or business. It can't be a corner of the kitchen table where you also eat dinner. Regular use means you use the space consistently for business, not just occasionally. If you use your home office a few hours a month, that might not cut it. So, how do you calculate this magical deduction if you meet the criteria? There are two main methods. The first is the simplified method. You simply multiply the square footage of your dedicated office space, up to a maximum of 300 square feet, by a rate prescribed by the IRS. The second option is the actual expense method. Here, you calculate the percentage of your home that's used for your office. You can then deduct that percentage of your eligible home expenses, such as mortgage interest, property taxes, rent, utilities, and homeowners insurance. You have to keep meticulous records of all these expenses. It's more work, but for some, it pays off. Choose wisely, young Padawan. Section 5. Giving back and getting back. The charitable contributions cheat sheet. Feeling generous? Good for you. And guess what? The US tax system might just give you a little something back for your big heart. We're talking about deductions for charitable contributions. This is one of those write-offs that feels good on multiple levels. The IRS wants to encourage philanthropy, so they allow you to deduct donations made to qualified organizations. So, what kind of donations can you actually deduct? Cash is king, of course. Writing a check or making an online donation to a registered charity is the most straightforward way. But you can also donate property. That bag of old clothes you dropped off at Goodwill, the vintage armchair you gave to the local shelter. Those can be deductible at their fair market value at the time of donation. Record keeping is absolutely paramount when it comes to charitable deductions. The IRS isn't just going to take your word for it. For any cash or property donation, you need a receipt from the charity. Now don't get too carried away thinking you can donate your entire salary and live tax-free. There are limits to how much you can deduct for charitable contributions in any given year. If you donate more than the limit, you can sometimes carry over the excess to future tax years. Section 6. Wait, I can't deduct my cat. Common write-off blunders. Alright, let's talk about the oopsie daisies of the tax world. The common mistakes and misconceptions people have about write-offs. Misconception number 1. If I use it for my business, even a tiny bit, I can deduct the whole cost. Not so fast, eager beaver. Another classic blunder is thinking that business meals are a free-for-all. The primary purpose of the meal needs to be business discussion. Also, the idea that if I don't get caught, it's fine is a terrible strategy. Tax evasion is a serious offense with hefty penalties, interest charges, and potentially even criminal prosecution. A very common error is the sloppy mixing of personal and business expenses. Using your personal bank account and credit card for all your business transactions is a recipe for disaster. It makes it incredibly difficult to accurately track your legitimate business deductions and can raise red flags for the IRS. Open a separate business bank account and get a business credit card. It's one of the simplest yet most effective ways to keep things clean and clear. And the cardinal sin of deductions, failing to keep adequate records. You might have a perfectly legitimate expense, but if you don't have the proof, the receipt, the invoice, the mileage log, the IRS can disallow it during an audit. The burden of proof is on you, the taxpayer. So get organized. Use accounting software, scan your receipts, keep a detailed logbook for travel. Treat your record keeping like the foundation of your financial house. Without it, things can crumble. Section 7. Not so fast. What you absolutely positively cannot write off. Now for the part of the show where we burst a few bubbles. While write-offs are fantastic, there's a whole universe of things you simply cannot deduct. The biggest category here is personal living expenses, the cost of your groceries, the rent or mortgage on your personal residence, your everyday clothing, your Netflix subscription. These are all generally non-deductible. A classic example that trips people up is commuting costs. The expense of traveling from your home to your regular place of work is generally considered a personal commuting expense and is not deductible. Thinking of influencing the political landscape? Good for you, citizen. But don't expect a tax break for it. Political contributions, whether to a candidate, a political party, or a political action committee, PAC, are not deductible on your US federal income tax return. Similarly, for most businesses, expenses for lobbying government officials are also not deductible. And here's one that should be a no-brainer: fines and penalties. If you get a parking ticket while rushing to a client meeting, or a speeding fine, or any penalty paid to a government agency for violating a law, you cannot deduct these amounts. The government isn't going to give you a tax break for breaking its own rules. This also applies to penalties for late payment of taxes or underpayment of taxes. So try to stay on the right side of the law, and if you slip up, don't expect the taxman to soften the blow. The IRS isn't going to subsidize your existence. Your daily slog to the office? That's on you, I'm afraid. Section 8. Still can't deduct it. More IRS computer says no moments. Just when you thought you had a handle on what's off limits, there are a few more categories of expenses that the IRS firmly places in the cannot deduct pile. Let's talk about certain capital expenses. If you buy a significant asset for your business that will last for more than a year, like a building, a large piece of machinery, or a vehicle, you usually can't deduct the entire cost in the year you bought it. Instead, you generally have to depreciate it. This means you deduct a portion of its cost each year over its useful life. Another no-go area is expenses related to earning tax-exempt income. If you have income that isn't subject to tax in the first place, you can't then deduct the expenses you incurred to produce that tax-free income. This one should be glaringly obvious. But let's state it for the record. Expenses related to illegal activities are not deductible. If your business involves activities that are against the law, think drug trafficking, illegal gambling, or selling counterfeit goods, you cannot deduct the business expenses associated with these enterprises. The US tax code does not provide tax benefits for criminal endeavors. Finally, let's touch on hobby losses. Sometimes, what starts as a passion project or a hobby can blur the lines with a business. If it's deemed a hobby, you can generally only deduct expenses up to the amount of income you earn from that hobby. The IRS looks at factors like whether you conduct the activity in a business-like manner and your history of income or losses. Section 9. Stay organized, stay honest, your ultimate tax sanity guide. Navigate taxes without losing your mind or attracting unwanted attention. The key is meticulous record keeping. Keep every receipt, invoice, and bank statement. Use accounting software or a well-organized spreadsheet. Separate your business and personal finances. Open a business bank account. Consult a tax professional if needed. Their fees are often deductible. Be honest and accurate on your tax return. Deduct responsibly.